So last week on this channel, we covered 4 dividend stocks on the US market, 4 companies that have virtually no debt or barely a little bit with Fastenal. Most of them were dividend growers. They were great, I would say like great picks to just put on your watch list and start doing some digging. And today we're doing the same thing on the Canadian side. Unfortunately, 3 of them are not offering a good yield. So if you're in for a high yield type of video, you're definitely not on the right channel for today. But I offered you I will offer you 4 companies that has a very low amount of debt, which is a really good thing right now because interest rate keeps going up and we can see that it's starting to become a real burden for some companies. LO telcos, LO utilities, LO REITs, LO banks. That's a lot of sectors that are having a hard time, so those companies will not have this problem. Dividend growth investors, bonjour. My name is Mike Hiro and I am the founder of Dividend Stocks Rock. I also have this YouTube channel to help you invest with more conviction so you can enjoy your retirement. So let's get started with some of my favorite low debt stock on the Canadian market, and it's Richelieu Hardware. Why it's one of my favorite? Well, it's one of them that is actually showing a pretty strong dividend triangle. As you can see now, the earnings and the revenues are going through a plateau in 23, but you have to keep in mind that's all because of renovation is slowing down. So what's Richelieu Hardware does? Well, first the ticker is RCH.TO. Small business, roughly like $2.3 billion in market capitalization. So almost a small cap, offering a 1.44 yield. So not crazy here, but the business is incredibly well diversified. So they offer everything that you may think of in terms of small pieces of hardware for your kitchen, for your cabinets, for your bathroom. They have over 130,000 different pieces of hardware that they're selling, and they're selling this across North America. As you can see, revenue earnings are going up pretty steadily, and the dividend has started to pick up also. So Richelieu Hardware is in a pretty good position where they are just selling like small parts to the Lowe's and Home Depot and Rona of this world. And at the same time, everybody needs those, right? You do some renovation, you build a new house, you'll need those small pieces of hardware. One thing that I like, especially for a small Canadian company, is that they're well diversified across both Canada and in the US. So they have 112 interconnected centers, so a lot of distribution centers in Canada, a lot of them in the US, to cover as much ground as possible and to become a great supplier. So obviously RCH is a small competitor in a big market, but it's highly fragmented. They are like companies selling all kinds of different parts. There's a lot of growth by acquisition potential, and since they have no debt, they may get acquired one day, so that could also offer a nice premium to the stock price. Moving on to number 2, Franco-Nevada, which is kind of interesting for both American and Canadian investors because FNV trades on both markets, the TSX and the New York Stock Exchange. This one is quite interesting, and you don't hear me talk a lot about gold-related stock in the dividend investing universe. I'm not a big fan of commodity, however, this one is quite interesting. First, it has no debt, so that is one thing that is quite interesting. But also, if you can look at the dividend that always increase, that the revenue and earnings are relatively stable. Well, here's the thing. Franco-Nevada is not a mining company. It is actually owning the asset, the land, and then it rented out to gold explorers and miners, so those companies have to pay a royalty fee. So we call that in the business a streamer. So they do not have any risk around the exploration or the mining stock. They're just like, you know what, if you take anything out of the soil, well then boom, you have to pay me something. It's worked well. They have no debt. It has like a constant flow of income all the time. Obviously it's a bit cyclical, but that could be quite interesting. In terms of yield, we're talking about 1% yield, market cap of 36 billion. So it is a relatively large company, and it's actually doing business across the world. So one of the most important thing here about Franco-Nevada is it owns 427 pieces of land. They are making deals and partnership with the strongest and the most reliable gold miners across the world. And this is how they are able to make so much money and create something very stable. So they are quite present in North America, but also in South America and Australia and a little bit of Africa. So in terms of like geopolitical risk, it's quite minimized, even though it would fall onto the mining company's problem also. But overall, well-diversified business, no debt, predictable cash flow. It starts to seem like something that could be interested in investing eventually one day. Now, number 3 is quite similar in a sense that we are also talking about a streamer earning royalties on a commodity. This time is iron. And the interesting part about Labrador iron ore is its yield. Obviously, it pays a variable dividend. As you can see, it goes up and down all the time. So the way they have decided to build their business is whenever the iron spot price is high, they're giving you a lot of dividends because they're making a lot of royalties. And whenever it drops, well, they reduce the dividend and just make sure that they continue to maintain a good balance sheet, a solid balance sheet, and they are not into financial problems. I kind of like that kind of business model. Obviously, you cannot expect to always earn that 9% dividend yield. Sometimes it's going to be 13, sometimes it's going to be 5. It fluctuates over time, but is quite interesting. So if you're up for a roller coaster ride, Labrador iron ore could be quite interesting. It offers a 9.4% right now, and it shows a market capitalization of $2 billion. So here you can see the structure where they have equities on land, and then they're receiving a royalty of 10 cents per ton on everything that is getting extracted, which is a pretty smart and pretty solid business model. And one other thing that plays in their favor for Labrador Income Ore is the quality of their assets. So you, like miners, are able to extract high quality iron ore, which makes a big difference when you have to sell it because it's worth more and it's easier to extract. So those are like key advantage for LIF that pretty much nobody else can replicate because it's all about the land that they own. Last but certainly not the least, one of my favorite company that is not a dividend payer per se because it offers a yield of 0.20% right now, and it never grew since they started the dividend. Kind of like a funny joke, I'm pretty sure that during the meetings of shareholders for Constellation Software, one guy wanted to make a joke. He said, hey, you know what, we're gonna pay $1 USD dividend every quarter just to have fun. And then several years later, they completely forgot about that dividend because they are too busy making acquisition. When we're talking about growth by acquisition, we're talking about Constellation Software. This is a quite interesting business. The market cap is now at $57 billion. So we're not talking about like a small cap here. We're talking about a solid business, but they're making tiny deals. And this is where the magic happens. With tiny deals, they come into play where there are no competitors. That's usually smaller for venture capitalists. So they're not really interested in those, but they come with this impressive expertise and they're known in the market. So they get there and they're just like, you know what, we're gonna buy your business, you're gonna stay in place, and we're gonna give you our playbook to make even more money. So they're making like small bits and pieces of deals all the time. Very easy to integrate this, and they actually created a literally constellation of businesses. So as you can see on this table, you have like different segments. So each segment is like a business by itself, and then a bunch of different industries. So they're always in the software business, they're always in the tech, but it's all about small niches where you have like almost no competitors to buy, but that business has almost no competitors either. So they can generate a lot of cash flow, and with their playbook, they find growth. And it has been a kind of like a recurring business model for growth. They have a huge pipeline. We're talking about over 40,000 companies that are on their radar. So it's kind of just crazy. They are literally buying businesses pretty much every week. Quite exciting business. Obviously, if you're looking for income, that's is not your type of investment. But if you're looking for total return, maybe you would like to put this one on your list. Obviously, Constellation Software have a few $billion in debt, but when you're talking about like $2 or $3 billion, while the market cap is at 57, we're definitely talking about a very solid business with a robust balance sheet, and most importantly, it generates a ton of cash flow. How it ended up on my radar? Well, it was there for a very long time because the company was showing growing earnings per share, growing revenue. So you can see that we're almost there for a strong dividend triangle, but it stayed under the radar because of the lack of dividend growth. Eventually, I was looking at it and I'm like, you know what? This is possibly the best play in Canada if you're looking for a Canadian technology stock. If you want to have more ideas like those, I would suggest you to download the Rockstar list right at the bottom here. The link is in the description below, sorry. The Rockstar list is updated by Dividend Stocks Rock, my paid membership, but it's 100% free. It's updated monthly, so every month you can download a new one. So if you subscribe to the newsletter, you're gonna receive a notification say, hey, the Dividend Rockstar list is updated. We cover like a few hundred stocks in there that has a positive dividend triangle, meaning that they show for 5 years earnings growth, revenue growth, and dividend growth, both on the Canadian and the US market. So you have like a wide selection to start your research. Obviously, they're not all buys, but you have like a big list of strong and smart ideas to start your research. All right, people, let me know if I have forgotten about one low debt, high quality stock. You know, it's not always a good sign because sometimes a company that has no debt means that it doesn't use leverage enough and will not grow enough. Some others ended up being bad investment as well. Someone in the comment section for the US part discussed Enghouse that had virtually no debt, but unfortunately not doing that well. This is why it's not in this video either. But so let me know if you have any other Canadian stocks that has virtually no debt or very low debt that are quite interesting, so we can build that list together. So see you in the comment, and until the next Thursday, don't forget to stay invested.